glad to have another opportunity to talk to you about financial accounting. This opportunity will include internal control and cash. There's not much in terms of concepts, I think, that you'll need other than just really thinking about how do we safeguard money? How do we safeguard our assets? Whether it be in cash or currency, whether it be money market securities, other investments, even long-lived assets. How do we protect those? And how do we ensure the financial integrity of the information that we provide external users? Internal control really helps us facilitate that goal, giving individuals and others information that they can rely on. So we're going to talk about fraud and and the impact it has, particularly with recent events. We're going to talk about some components of internal control and really the overall objectives of internal control. We're going to really look at a bank reconciliation, and I think this one here will be something practical for you as well, because you can use it for your own personal bank statements. Not necessarily to see if it's anyone stolen from you, but to make certain that there are no errors, and also that you can maintain some level of control over what's happening within your own personal bank accounts. We're going to talk about the internal controls over cash receipts and cash payments. We're going to use a cash budget and also think about how to construct one. And again, this has personal implications. You can actually do this for your own personal use. So I'm hoping this probably be one of the most practical chapters that you'll ever have in this course, because it really does have implications both for you and your business, and just really hands-on, easy things to implement if you're not implementing them already. So fraud is going to be intentional. It's really important to say it's intentional. If someone makes a mistake and misrepresents some information, then I would say that's not fraud. I think that that's an error that you need to catch and you need to correct. But fraud, in its distinction, is you are actually intentionally misleading. Misrepresenting information. So it's very important with fraud is being described. It has to have that word intentional. And it's to persuade somebody. It's to actually get somebody to give you money or to hide money or whatever the reason, but you're trying to convince somebody to do something. And it literally causes damage to an organization, to the person who's been defrauded. But it's also a very, very huge problem in the expansion of e-commerce. And we talk about handling financial transactions via the internet. So it's important for us to kind of understand that with e-commerce, you got a whole level of areas where you can be actually defrauded. So think about the types of fraud. You can fraud can be committed by employees within your firm or within any society, or it could be theft of inventory or money. You could take somebody's money. You can actually rob a bank. Not to say that you would. Bribery and kickback schemes, which is why major corporations as well as government or agencies require individuals to explain and to expose their relationships with other major companies, just to make sure that there's no bribery, there's no way that they can actually come in and use that influence to gain an advantage over another. Financial reporting can be committed by your managers. It can be misleading false entries. Again, when someone's trying to hide that they stole something, these entries could be to cover it up, basically. And the intent will be to deceive investors or creditors or anybody who has a need to use your financial statements. Again, we're talking external financial reporting. It's very, very important when we're talking about financial accounting and when we're using GAAP, because what you use internally, managerially speaking, what type of reporting you use is really only for the users internally. But external reporting, we have to have a certain level of standards. So the fraud triangle, motive, people have to have a reason, and they almost always do have a reason. And every time I've experienced fraud within the organizations I represented, motive was a very important indicator, very important. And sometimes you don't always know this until after they have done this, but nevertheless, the motive. It could be a financial crisis. Someone has lost their spouse lost their job, and now they're not able to make their payments, and stealing from the company makes their payments. You know, they have to have an opportunity. An opportunity is going to be a gap or a hole or some kind of internal control weakness that individual may be able to exploit and use, and just at the right moment seize the funds or the other assets that they may be trying to steal. Rationalization. I had to do this, but I would have every intention of paying it back. I was in a bad situation. I needed to pay this creditor, or I was going to lose my house. They rationalize. what they're doing, why they're doing it, and they have opportunity and motive to do so. So what is the objectives and the components of internal control? It's a way to prevent, if possible, or detect or incorrect fraud. That's the whole purpose of it. It really is designed to prevent. But as we all know in society with e-commerce, it is sometimes almost impossible to detect certain types of fraud, or sometimes it's even impossible to prevent it. But we want to be able to have a way to make it very difficult, if not impossible. Make it difficult for someone to steal from us, someone to defraud us. The objectives include safeguarding assets, and this is primarily the list of cash, inventory, office equipment, and other plant equipment. We really want to make certain our assets are protected from theft, from misuse, from abuse, that sort of thing. We want to make certain that we have a policy that is adhered to and that is well understood by employees of that organization. And the goal is really to make certain that everything works well, that everyone works together well, and we get the product and services out in the manner in which we intend, at the most effective and the most cost-efficient process possible. We want to make certain that people can rely on financial information we provide them. We don't want to know that someone in our organization is putting entries in that are incorrect and wrong to hide that they are stealing from us. So we want our financial statements to be relied on. And most of all, we want to comply with legal requirements. I mean, we obviously got to prepare statements and prepare tax returns based on that information. And there's a very, very significant consequence to unreliable information you give into legal parties, whether it be a contractual agreement with a third party, whether it be with the IRS or the SEC. It's quite important that this information is accurate, and we need to make certain that we ensure that it is. So here is an excerpt of a report on internal controls. And again, the management is responsible for establishing and maintaining internal control over financial reporting. The company's internal control over financial reporting includes the maintenance of records that accurately and fairly reflect transactions and assets of the company, provide reasonable assurance that the transactions are recorded as necessary to permit preparation of financial statements in accordance with GAAP. And it goes on. This is a very, very good statement because it provides the organization and its employees exactly what internal controls means to them and why it means that to them. It's very, very important that employees understand what their role is in ensuring that everybody, is following the rules. And the people who are not following the rules, there are consequences to that. This internal control memo that we just read really was the product of the Sarbanes-Oxley Act. Years and years ago, back in 2002, there was massive fraud committed by upper management of an organization. And the public accountants who were auditing the firm knew about it and was concealing the information by shredding documents. This major fraud cost taxpayers, cost the employees, and ultimately destroyed two major organizations. So the cost was huge. And the SEC got involved because we felt like this is the time where we need to say to auditors, you've got to get your act together. You cannot sit back and watch this sort of thing, and you're going to be held accountable for what you know. And you're going to have to be, and one of those processes includes rotating of audit firms, limiting non-audit services that auditors would perform on their clients, really making certain that there's a clear distinction of independence and significant penalties for violators. It should never have come to that, but in reality, this is the world we're living in. We're living in a world where things really have to be spelled out. This is what their expectations are. This is what you're obligated to do. This is what what's going to happen if you don't. And many years have gone by, same auditor, 20, 30 years, no real independence, and as a result, we have this act. And again, this Sarbanes-Oxley Act does apply to public companies, but again, its model does trickle through to other private entities. So, the shield of internal controls. Internal controls is designed to ensure that fraud is detected, if not at all prevented. It ensures that organizations resources are not wasted, and making certain that the resources they do have are used in the most efficient way. And this is all the barrier against the actual company assets. What I would like to say in all of this is, when we're as accountants working in an organization, we want to make certain that the information that we provide is accurate. We want to make certain that we're doing the right thing in the right way. We want to make sure that we're following the protocol and the procedures outlined by the organization. At the same time, when we observe behaviors that's inconsistent, we need to have a mechanism, a policy in place to ensure that we can report that activity to them, and it protects everybody. Knowing that you can monitor internal controls and make certain that things are operating efficiently will almost guarantee that you'll still be employed, because many companies go under because the fraud is so pervasive and had never been caught until the damage is so significant that a company can't continue to thrive or survive. So it's our responsibility to be good stewards of resources that are being trusted to us to use in the performance of our jobs. But at the same time, we need to make certain that we understand exactly what internal controls is meant to accomplish and how it does that. The control environment is like a roof. It really does cover over all of the activities that are necessary to implement and monitor internal controls, including the process of control of the activities, the procedures, the internal controls using information technology, computer systems, using the internet and access to data and files, and the sharing of that information. Also, the actual integrity of the information being put in, of course, and then the monitoring of that. And so it's very important that managers and leaders of the organization establish that tone, establish it in the sense that it's written, you are signing it, and you're going to be held accountable if you do violate those terms, meaning termination is ultimately going to be the consequence, and they need to follow through with that. Otherwise, an internal control policy makes no sense and it's absolutely useless. Identify the risks. Again, depending on the organization, your auditors will work with you. What type of business risks associated with the type of organization that you're trying to run, and establish policies and procedures designed for those risks. No risk assessment can cover everything, but again, an organization does know significant variables that potentially expose them to liability or loss. Information system. How the information technology interacts, how people interact with those systems, how their job functions, and where they're allowed to access information, and to what extent they're allowed to access information, and reporting to control that. We need to make certain that information that we put in can be tracked. We can track assets and profits, and we can make certain that accounting information the integrity is sound. Why? By ensuring various individuals with various levels of responsibility are only allowed to do what their job function requires. And then companies gain access of these objectives. How do we do it? How do we put together procedures? Well, we have to have job descriptions. That's one good way. Have supervisory authority, having separation of duties, lots of different things that can be done to ensure that policies and procedures can be put together and ensure that we can protect the assets. And then monitoring it. External auditors are key. Internal auditors also are important as well. They come in after the fact and they provide a report. They assess. They test whether or not those controls are actually in place and performing as intended. Very important step. So what do? When we want our internal control procedures to work, we need to first of all make certain we're hiring the right people. We need to ensure that our background checks are not only done for every employee, but are reviewed. Make certain that people who have criminal histories that relate to stealing of money don't have access to money. I'm not saying you can't hire the person, but you most certainly don't want to put them in a position of theft if they have been in trouble because of that. Making certain that employees who are there are trained and adequately supervised. No one should be a lone rogue doing anything and everything they want to do. They ought to be supervised and held accountable for what they do. Giving people competitive salaries most certainly, in many ways, does remove some of the motive for people defrauding the companies that they work for. And making certain that employees are held responsible, making certain that they understand exactly what they're responsible for, which is why I think that's pretty important. Internal control procedures means separating the duties. I don't want my employees to handle cash, record the cash transaction, and then record a transaction, and then be able to approve. It's just these functions have to be separated. And for the company within the 2002 fraud, major Enron fraud, a lot of that was blurred. And again, basic common sense type of functions were overlapping. People were getting put in a situation where they had opportunity to steal. And all they needed was motive and that rationalization of it. And that was pretty much it for the organization. Compliance monitoring. Monitoring the operating budget. Comparing it with actual. It brings out questions that one has to have answers to, and going through the records to find answers. Exception reporting. What is a procedure? And run a report to see how many times that procedure was deviated. Very important. It will highlight problems, errors, and possibly fraud. And in audits. Organizations most often hire external auditors. Major organizations not only have an external auditor, but they have an internal audit group whose responsibility is to check, and then their work is checked by an external auditor. But again, having an auditor, whether internal or external, is a very key part of the internal control procedures. Having adequate records. Everything has to have some sort of trail. Knowing what the trails are and being able to trace transactions from beginning to end and backward is very, very important. So you'll need hard copies of documents, electronic copies if necessary. And when you have numerical documents like check numbers, like purchase orders and other cash receipts, journals and cash receipt or cash or invoice numbers for your customers, those numbers should be not only accounted for and tracked. So that if you see a missing number, you want to say, well, what happened to this invoice? Why is this invoice number missing? Why is this PO number missing? That's a good way to find out that something incorrect, something wrong has happened. Limiting access is another way. Keeping access of assets under lock and key, meaning only people who have the authority to have access will have the key. People having custody of certain controls, separating it. Passwords, encryption. Passwords is also important. Changing your password every 90 days is absolutely essential. And I see it in more companies than I don't. You're not allowed to keep your password for longer than 90 days. It automatically requires you to keep it. And having data encryption, meaning that someone can't come in and hack. This is sometimes fraud does not always happen internally. Sometimes somebody on the outside may come in and try to steal from your organization. Approvals. If there's going to be money coming in or out, there's got to be approval. That means if you're going to grant credit to a customer, it has to follow a process. They have to go through and determine this organization is a viable entity, whether or not this organization has the credit fitness to work with your organization and meets the standards of your organization, policies, credit granting policies. Purchasing department, same thing. That purchase has to be made with a valid purchase order obtained through a purchasing agent who has the authority to bind the organization. And it has to make certain that invoices are approved and attached to those POs. And human resources, again, proper approvals for hiring of new people. You don't just bring somebody in, false entities, and make them people and give them a check. Again, having the human resources department involved and having a process for hiring people and making certain that these people are real, in fact, people before paying them their salaries. IT is another, again, because we're of the e-commerce and all of the interaction via the internet, it's essential to have a highly effective and completely secure information technology. That includes having accurate information, using barcodes, using passwords, using encryption when you're talking about handling transactions online with your customers, that sort of thing, to ensure the integrity is fine. So, important documents, you make certain that they're in a vault that's fireproof, and even off-site, quite frankly. There are a number of organizations that maintain data security off-site that allows you to be able to not worry so much about the integrity of your hardcover documents is being maintained by an external party. Burglar alarms, security cameras, again, depending on the organization, security cameras can be critical to identifying improprieties. Loss prevention specialists, bonding on cashiers, again, bonding on individuals who have access to cash, not necessarily writing of checks, but literal currency becomes absolutely important. Mandatory vacation and job rotation. Again, this has everything to do with one person doing one thing all the time and never leaving, in which case they could be hiding and stealing without it being discovered quickly. So requiring employees to take off, requiring people, individuals, multiple individuals doing the same job in rotations is also another way. And again, it depends on the organization and its ability to handle these types of procedures. Some organizations may have to weigh the cost-benefit analysis and say it costs too much for us to do this, but we can do this, and hopefully that should be sufficient to mitigate these risks. Again, it's all about your organization and what this organization is trying to accomplish and how it can do it efficiently within reason. In e-commerce, obviously, is going to have its own set of risks, which again, I mentioned it's no 100% foolproof mechanism, but it is controls that we will most certainly want to talk about. Stolen credit card numbers. There have been some cases just, I think, in the last 2 weeks, and we're in 2019, where an employee of, I believe it was Target, was stealing the credit card numbers of the customers when they swiped their cards. That's a critical error, and that's a critical mistake. And again, the Target had to pay for that. You're talking, we want to make certain, how can the employee do that? If they had security cameras placed very close to the cash register, could that problem have existed? Hard to say. Maybe, maybe not. Trojan horses, again, within your own organization, teaching your employees through training, effective training, what invoices or what emails you're allowed for there should be opening and what happens, and having ongoing training for phishing and all sorts of type of viruses that can be placed on your computer and then damaging the integrity or even stealing information. You really need to have a strong internal control system in place with your information technology, but you also have to be able to teach your employees what to look for and how to conduct themselves when they're online on the behalf of the organization. And again, this is showing firewalls and so forth. And I don't want to get into all those details because it's all information technology. The main emphasis here then is to ensure that the organization has certain level of firewall protection to prevent or delay any type of intrusion. Limits of internal control. Again, costs and benefits. Collusion. When 2 people work together, even 3, there is no way to catch it. It have to be through an accident or through through possibly a whistleblower, but collusion is something nothing you can do. Just hope for the best that people don't collude. Management override, which is the major problem with Enron. Management overrode a lot of the controls they had in place, made them of absolutely no effect, basically just completely destroying the integrity of the organization. Human limitations, when people just get tired or just plain lazy and they don't follow up on things that they know they would if they had been more alert to their jobs. So we have to make certain that the benefits outweigh the costs. And again, size of organization may very well drive that. So now let's think about putting together some kind of reconciliation. Why do we do a bank statement? A bank statement provides you with information on all the transactions that occurred in your bank account. That means money coming in through your revenues and cash receipts, money going out through your checks or ACA debit payments. So we want to be able to control the bank account. We want to make certain that information on that bank account is safe and all the money that's in that account is safe. We want to first start, how do you open the account in the first place? Making certain that only individuals who are given authority have a signature card. Making certain that the deposit tickets are most certainly kept out of reach. Checks, etc. are out of reach and locked. Bank statements and reconciliations. Again, the signature card is going to say who can sign on that account. Deposit tickets and checks are going to be in the individuals who can put money into the account, and checks are going to be individuals who are able to write checks and take money out of that account. Using your bank statement and reviewing that bank statement and reconciling to your general ledger is an important step. So again, it protects against fraud, forgery. Standard bank statements and deposit tickets really does help understand or help to ensure that when we have a deposit, we can tell who made the deposit and when they made the deposit, and we can match it to the bank statement when that comes. Again, checks are not written as much as they were 20 years ago, simply because we have ACH and we have those type of electronic transfers. But nevertheless, checks are still being cut, and we need to make certain that when we write checks that, again, using the reconciliation, we know we wrote the check did clear, and all of those transactions have to be tracked. Bank statements, you get once a month, and it definitely gives you an idea of what's happening within your account, both inflows of money and outflows. Here's a basic bank statement, which I'm certain all of you have seen before. The difference here is we're looking at it not only from our personal accounts, but actually we'll be able to determine the accuracy of the statement, and it can be used as a tool to determine if there are errors or if there's theft. If adequate controls are in place, a bank statement can give you a load of information. So bank statements provide a difference, and it explains what those differences are, because what's going to happen when you look at this bank statement here, it says like your balance is $5,900 at the end of 2016. Well, your bank balance on your books may say something different, and your job is to say, my book says this, the bank says this. What are the transactions that make up that difference? And here is an example. And again, using your own bank statement as an example, you can say, okay, I remember I'm making a deposit on this date. Why didn't it hit? Oh, it didn't hit because I made it through my ATM machine, and it takes 2 days for it to hit the bank. That's my deposit in transit. On my book side, the bank recorded some transactions. I don't have any idea what those transactions are. Oh, I collected on a note. Oh, I had this service charge or interest revenue. And again, these are the type of transactions that may very well hit one and not the other. And your job is to reconcile those items so that you can get to an agreement. So here is an example of a bank reconciliation. What I'm not going to do in this presentation is go through a reconciliation. I'm going to do that as a demo. But the main thing I want to show is the bank has one balance, the books has another balance, and your job is to find out what differences exist on each side and see if you can come to a reconciled or adjusted book/bank balance as shown here. And in some cases, when you do see these adjustments, you have to remember there are times when you will have to record these transactions, as you see in the journal entries here. So, as summary, with your bank balance, you're going to add any deposits that you have on your books that the bank does not. You're going to subtract any checks that you've written on your books, but the bank has not received those checks. You're going to add or subtract for bank errors. On your book, on your book side, you're going to always add any bank collections or any kind of receipts that the bank has received on your behalf and post it to your account that you don't have on your general ledger. You're also going to subtract any bank fees, NSFs, or anything else that you have taken from your bank balance that you should show on your general ledger, and any adjustments relating to corrections, etc. So these are kind of the scenario of what type of transactions you'll need to record in order to get the two accounts to agree. The most important thing is understanding when the book balance is reflecting something and the bank does not. That timing difference has to be shown in the reconciliation, but you do not have to record anything. Or in the case of there is a cash receipt through payment electronically that your bank has received but you haven't recorded, you'll have to record on your books. So, internal controls over cash receipts and cash payments. And again, cash is going to be a specific cash control because you're going to have to make certain that you really have tight controls here, because it's very easy to steal and it's easy to convert to other forms of wealth. It's very easy to steal cash. So having a cash receipts policy and procedure that's airtight is going to be extremely important. And these are some examples of how to ensure that there are some sort of controls in place to prevent theft of cash. And here is another diagram. Again, I think these little diagrams are very intuitive and they make common sense. And in fact, I think maybe if you have a job in accounting, you might understand your role in that process. Payments over check. Companies, most pay by EFT, but some pay by check. And most importantly, you want to have a record of your payment. It's authorized and it's supported by evidence. As you can see here, the following responsibilities listed here should not be performed by one person. And that's most important. Someone who buys the goods has to be different from the person who receives it, from the person who actually puts the invoice in the system for payment, and the person who actually approves the payment. They have to be different. And look at this little here spreadsheet here. It shows a purchase order, inventory, receiving report, and the payment. So what happens with this is you want to be certain that you are buying from an authorized organization for the authorized good, that you receive that good, that good matches the amount that you agreed to pay, and that you paid it for the exact amount to the person to whom you are supposed to pay it. Simple as that. And these are the invoice and the three things that you need. Now, when I was completing accounts payable back in many years ago, one of the things that I had to have in front of me is I had to have proof that the items were actually received. Clearly the invoice is going to come. And then the purchase order, which I didn't create, had to be already approved and signed by the treasurer. So the treasurer said, we're going to pay for these types of services, and this is the dollar amount, and this is the vendor, and they sign it. So when I got a receiving report and an invoice, the receiving report is from the purchasing agent or someone assigned that task. They actually received that item. So I can say not only that I have authorization to pay it, but I have confirmation that the items were received, and the invoice is valid because it matches what we agreed to pay, to whom we agreed to pay it, and the amount that we agreed to pay. Very important information, and a lot of things can go wrong with that process. So it's very important that not one person is overlapping in their responsibilities, because not to say that if someone had an overlapping responsibility they would steal, but you're giving them an opportunity to steal, and that would be a contradiction to the internal control process from the jump, because you want to make certain that you don't give them opportunity to steal. You don't want to create that opportunity, and that could be a gap in internal controls. So having petty cash for minor expenses is never a bad thing. What happens with this is that the petty cash amount is extremely high. It's open with people. The voucher system is not adhered to. People are not reconciling it on a consistent basis, and the main party is there's not lock and key. I mean, you have to make certain that you have the money, currency, locked, that no one can get access to it, and that you reconcile it periodically. When it comes to cash, it should be reconciled every 2 weeks. It should never go a month with cash or with outstanding vouchers. You should always reconcile it, and it should be reconciled by a different person that actually hands out the money to the person who's requesting petty cash funds. So a cash budget really helps you know what you start with your cash, how your cash is being used in terms of receipts and money being spent out, but it also tells you where your cash availability is. Having a budget and then comparing that budget to what's actually being used and actually being spent really is an opportunity for organizations to kind of check and to ensure, why did we deviate? What happened here? That's the kind of questions that you want answered. What happened? Why did we deviate from what we had planned? Was it a mistake? Was someone stealing? What events occurred? And that's how you can lead to reporting information correctly, correcting it, and ensuring that accuracy, that no one is in fact stealing from you. So cash is going to be shown as cash and cash equivalents, and time deposits, but money in your bank account. CDs is which a higher rate of interest and savings. Securities, treasuries, etc. Time deposits could be a checking account, savings account, and so forth. And again, cash equivalent is highly liquid, highly liquid. That can be currency or money in your bank account. So again, we just want to make certain that you understand how important it is to maintain control over your assets, in particular emphasis on your cash. And my hope with this presentation that you can actually think about situations where you may need to monitor and control, and what procedures you have in place to make certain no one's stealing from you. I thank you very much for your time, and I hope to talk to you in the next video.